year and a half ago, a year ago, we were still looking at interest rates super low, right?
Correct.
Okay. That has changed dramatically.
Correct.
All right. So you can see that impact in those numbers.
Yes. And so what's interesting to me is obviously the reason why they raise the interest rates, right, is to control inflation and to curb it, slower growth, slower, steady growth.
Right.
What's interesting to me is, and we've talked about this before, is the idea that buyers buy a payment, not a price point. So for instance, rather than they buy a $1,400 a month payment, not a $400,000 house. They say, what can I afford from a monthly payment? And whatever that equates to, principal, interest, taxes, insurance, that's where I go shopping from. Interest rates in the last, what you alluded to, since last July, last spring, have gone from approximately 3.5% to over 7%. They've doubled. And so the cost from a mortgage perspective on a $300,000 mortgage went from about $1,300 a month to over $2,000.
Yep.
That's substantial. That's about 50%. The true cost out of your pocket to own and maintain a house is 50% higher. Yet, we're still seeing homes appreciate in value. That's really kind of, I don't want to say surprising.
An anomaly.
What that tells me is it all funnels back to supply and demand.
Sure.
The supply versus demand is that disproportional that it is withstanding such dramatic interest rates.
If we get